Hey everybody, you may have heard in the local media that the San Diego real estate market is in trouble. Well, we're here to take a fair and balanced look at what's happening. Eric, is the market crashing?
No, and I'll explain why here with real numbers and perspective based on past performance and
18 years of real estate experience?
That too, yes. So when we look at new listings for June of 2022, there were 3,966. And when we look at new listings for July, there were actually less. That's down 8.8%. But also, let me jump down here to number of homes for sale.
And this is a very recent snapshot of what's happening. We'll zoom out to longer trends in a minute. But
right.
Recent trends.
But most importantly, two things to keep in mind here. Pending sales have remained very steady. Through June, they were about the same as they were in July. This says down 2.1%, but that's actually a very small number. It's been very steady for the past 5, 6, even more weeks, number of homes that are selling.
And that's representing demand for homes, right? So we've got pretty steady demand.
Yes, demand for homes is very steady. And while the number of new listings, or the number of homes for sale, I should say, does appear a lot higher in June. This indicates up 14.2%. However, this is all of June 2022, and I've been watching this, both of us have been watching this throughout the entire month of July. The number of homes for sale really didn't change much. It's been skating right along this, 4,900 number. We haven't cracked 5,000, and it's been very, very stable for the last 5 or 6 weeks.
There was a surge of inventory and then it kind of stabilized and leveled off.
Right. I mean, I would say that the whole economy overall was shell-shocked in late May, early June, when the Fed came out and they bumped interest rates up, 0.75%. That hasn't happened in a long time, but they're doing that in an effort to curb inflation, to slow down the economy in effect. And it worked.
And not to get ahead of ourselves, but they did that again, another 3/4 point bump. And after that, mortgage rates actually went down a little bit.
That's right. Yeah. So initially, mortgage rates jumped up and people were sticker shocked. And that did cause, as you can see in the median price month over month, it caused the median price to go down 2.9%. But what we have to keep perspective on is that median price had gone up, I believe it was somewhere on the order of 17 or 18%.
Yeah, there were a couple of months where the year over year was very steep, and that's just not sustainable.
Absolutely not. So the median price was growing at a ridiculously unsustainable rate, and what the Fed did and what buyers did in response to what the Fed did really does seem to have calmed that down a bit. But it's not, quote unquote crashing. There are a lot of reasons why this is nothing at all like what we saw in 2008, in regard to a housing crash, as it were. And then you can see that closed sales are down quite a bit in July, but that's because pending sales were down from May to June. So
closed sales is a lagging indicator.
It is a lagging,
yes. What was happening,
right.
30, 60 days ago.
Right. So pending sales are steady countywide, and in some of the zip codes where they had fallen off sharply, they've rebounded sharply. And number of homes for sale has remained very, very constant.
And just anecdotally, in our business and what we're seeing out on the streets, the past couple of weeks we've been seeing a lot more activity. Homes that were sitting on the market are now getting snapped up. So
right.
It seems to be picking up out there.
Right. So with that, let's go ahead and move on to market activity.
And these are long-term trends.
Long-term trends for new listings. So, we look at July of 2020, July of 21, new listings were almost identical, and then less new listings in July of 22. So there's actually less homes coming on the market now by 21% than there were in either 21 or 20. So that that number isn't running away. New listings, if this number were running away from us, I'd be saying, oh my gosh, that's terrible, and we can't, prices are going to have to come down a lot more to soak up the new inventory. But with pending sales remaining steady and new listings being lower than they were this time last year or the year before, that to me is sort of a good thing. Homeowners are not panicking, I guess would be the
nobody panic.
Yeah, and they're not, and good for them. So let's move on to closed sales. Yes, closed sales are way off in July of 22 from 21, and for the reasons that we already discussed, being the shock to the system that occurred in late May, less pending sales in June equals less closed sales in July. So yes, closed sales in July are way off, and this is the number, mark my words, when you look at the Union Tribune later this week or next week or whenever they get around to it, it's going to be the headline. Closed sales down 43.6%. They'll round up to 44. But it really is a sort of meaningless when you don't put it in perspective. And so rather than sensationalize it, we really need to put this into perspective rather than doing what the Union Tribune is going to do and just causing a lot of fear, uncertainty, and doubt. Just know pending sales were a lot lower in June for the reasons we already discussed, leading to a lot less closed sales in July. That's just how it goes. Pending sales this month or next month's closed sales, we hope. So
for the most part.
Yeah, for the most part, unless they fall out of escrow and go anyway.
Well, there's always a few of those,
yes,
but anyway.
Of course. So then let's move on to inventory of homes for sale. As you can see, in the summer of 2020, it was way down from the year before, and then in the summer of 2021 we were still down, and now inventory of homes for sale is up. And again, these numbers, the inventory of homes for sale, when you combine this 3399 and the attached number over here of 1533, you get that 4900 whatever it was. But these numbers are not at all staggering in terms of history and in terms of the current level of demand or pending sales. Right now, what we've got sitting on the market is less than a 2-month supply of homes. It gives buyers a little more breathing room, but if sellers are just patient and price well, you're still going to get a great price for your home, and everything's going to be just fine.
Would you say this seems like a more normal market than we've seen in recent times?
This is a much more normal market than we've seen in recent times. You can't have runaway appreciation. You can't, I guess you can have runaway declining prices. We've seen that before. But this is not what's happening this time. We have had a real softening on prices, and just because interest rates bumped up, because there's more homes for sale, it kind of had to happen. So that's what's happening in terms of that. And then of course, looking at median sales price, where's it's up. It's up from 2020, 2021, 2022. Then year to date, it's up.
If you're waiting for prices to crash, you're likely going to be waiting for quite some time, if not forever.
Yeah, again, if we had runaway inventory, new listings off the chart, sitting inventory, hitting 3 months, 4 months of standing inventory, then I'd be thinking, we're going to see a lot more softening in prices. But it's just not getting any cheaper.
It's not stacking up either. The inventory is moving through. So
it's moving, right?
Yes.
And there's no boogeyman out there. There's no resets on adjustable rate mortgages. There's no
the boogeyman kind of already came with those rate hikes.
We think so. I don't know everything. I could be wrong. There could be another boogeyman lurking out there that nobody knows about.
Nobody knows.
But it isn't in these numbers. That's what all we really have to go on is past experience and data. And the data right now just does not look to me to be anything that crazy What it looks like is the market is finding its footing again. It's taking back off in terms of things clearing out and selling, and we just don't have a huge glut of new homes hitting the market. So then one of the things we already mentioned is that even though after the May bump we got another 0.75% bump in interest in the prime rate in July, mortgage rates actually went down.
I was relieved to see this chart too. I was pleasantly
yeah.
surprised at what happened after that latest rate hike.
Yeah, it's because the latest rate hike has given investors confidence that the Federal Reserve has a handle on what's happening. At least for now, there's confidence, and that confidence translates into the type of action in the bond market that leads mortgage rates to decline. And also because of the slowdown in borrowing in June, banks were like, okay, I guess we gotta relax a little bit.
We've got supply and demand at play too. If there's less demand for mortgages, well, they're going to make them a little cheaper to incentivize folks to get a mortgage.
Right. So the 30-year fixed sitting right at 5% essentially. And yes, that's a lot higher than it was in January, but this is not by any stretch of the imagination a historically crazy interest rate. This is actually a very low interest rate. Again, what we were seeing earlier was just not a sustainable model. And then if you can get yourself into a 15-year fixed, which I don't know that many people that wind up qualifying.
If you can get one of those, then good for you.
But the most people, what I see most folks doing now, especially in the higher end, is looking at this 5-1 ARM. And what this is doing is fixing your rate at the introductory rate of 4.25 for 5 years, and then somewhere in there you have to sort of play the market. And this is historically what people have always done, and this is why lenders stay in business, because of refinances. I mean, purchases are big, but refinances are generally a bigger part of lenders' business. So, this is going to actually lead in the future to lots of refis and better economic activity overall. So, good news all around in my view. Mostly good news.
All right. Well, good news is good news.
Indeed. Indeed it is.
Well, thanks for watching. If you enjoyed this video, please like, share, or leave us a message in the comments. We'll be back next time, and we'll see you then.